This episode is brought to you by Fidelity. Growth, it's fundamental, and wealth management firms of all types are proven to grow faster with Fidelity because we'll work closely with you to help make your vision come to life. Deep expertise, powerful technology, and unmatched scale. We have everything you need all in one place to help your firm grow. Move forward faster with Fidelity. Visit i.fidelity.com/growth. President Trump, he asked the DOL to consider democratizing, quote unquote, access to alternative investments.
First of all, I want to say I hate the word democratization.
I saw your skin crawl whenever I used it.
Yeah, I got a little icky. All right, welcome everyone. Welcome to the Advisor Upside Show. My name's Sean. I'm here with John. Today, we're going to talk about the DOL rule and some public comments that came about putting alts in 401ks. And we're going to get in some other topics as well. But first, we're a couple episodes in now. We're having a blast. I know John is as well. Please give us your feedback. We've had a lot of great feedback already, some great engagement on our YouTube channel and elsewhere. So please let us know if you have thoughts or comments. Let us know what's going on, what's working, what you want to hear about. Or if you want to come on, join us, come talk with us and hang out with us. We'd love to have that too. So your feedback is super important to us. I'll kick it over to John.
We would just encourage you to rate and subscribe to the podcast on your preferred podcast platform, or if you prefer YouTube, we're on there as well, where you can see Sean and I and our guests each week. The easiest way to give us feedback is at podcast@thedailyupside.com. We encourage you to reach out to us directly with ideas for the show, with segment ideas, guest ideas. If you're a newsmaker yourself and you want to throw your hat in the ring and join us for an episode, we'd love to have you. With that, Sean, why don't we head into the first segment?
So the big news of the week last week was the 40,000 comment letters that were sent to the DOL about proposed regulations that would, among other significant effects, expand access to private assets and other alts within workplace retirement plans. So your 401ks and other things. And the comments show the views are complicated, decidedly mixed, including within the financial services industry itself. As with a lot of these, you have sort of the advocacy groups on one side and the industry groups on the other. But to what extent the DOL will respond to the commentary as it prepares a final version of the regs remains to be seen, and advisors are going to be interested to see what they will do as this all shakes out. So, John, I know you reported on this a lot. We had a big story on it last week. Let's start off with what are the two sides of this coin, of this issue.
Sure.
What's the case being made for why alternatives should be included in 401ks?
Yeah. It's a very interesting story. And just a very quick comment. You don't see 40,000 comments on many DOL proposals. The norm is several hundred to several thousands. We've seen bigger in the past, but not too much bigger than this for a specific sort of retirement industry topic. So just off the top, I wanted to mention that. It shows that this has really struck a chord. The case for alternatives in 401k plans, I think on paper, it makes a lot of sense. And it was actually sort of brought to the fore by an executive order from President Trump. I don't remember exactly when that was. I think it was late last year. It might have been in the like January, February period. But he asked the DOL to consider democratizing, quote unquote, access to alternative investments. So things like private credit, private equity, real estate, potentially all the different categories of alternatives that are out there. Really opening up those sorts of investment opportunities for your mom and pop investors who have most of their money stocked away in a 401k plan. And the argument there is that, pension plans and other institutional investors, your big, college endowments, city endowments, they've been investing in alternative assets for decades and decades. And it works out for them. It's sort of a volatility hedge in some cases. It depends on the asset class, of course, but they're, a pretty substantial allocation in your typical institutional investor's long-term portfolio. And there's good reason for that. So naturally, you would think, 401k plan investors get access to these things. Maybe outside of the world of 401k plans, for a lot of these investment opportunities, you have to be an accredited investor to access some of these things. Some of the listeners will know a lot more about this than me, but the basics are that a lot of these potentially lucrative, interesting, hedging sort of investment opportunities aren't really in the reach of your typical investor who may only have $100,000, $200,000, $300,000 saved. So in a sense, the 401k plan could be a good vehicle for getting these products into the hands of people. And so that's the case in the pro side. And Sean, I think it makes some sense, right?
Yeah, for sure. And I think this is one that, well, first of all, I want to say I hate the word democratization.
Yeah.
I think it's like such a
I
buzzword to
saw
me.
your skin crawl whenever I used it.
I got like, yeah, I got a little icky. But I don't know.
Yeah.
I don't want to come down on folks that use it. But what I was going to say is that, yeah, I do think it makes a lot of sense. I actually talked to one person who provides alternative investments, but he said, especially with long time horizons, like you would have in a 401k, right? Like you don't need 100% of your assets, 100% liquid, 100% of the time. Like there's
Yep.
definitely a case to be made that let's get some of it at least. I think the institutions that you said have been using for decades, they're usually around 30% or something. Your regular folks like me and you are 0 to whatever we can get into. Reason of that is a lot of the bars just to get into these deals are $1 million, $5 million. So it is an interesting opportunity for sure for the regular Americans to see some of these, like you said, lucrative gains. It does come with downsides and with some potential risks, some complexity, more expensive, for example. What are the big drawbacks or what the critics are saying?
Yeah, yeah. I mean, you kind of pointed to them right there. It's the inherent complexity of a lot of these products and thinking through how that could actually work with the complicated plumbing, that is behind the scenes in the 401k plan industry. Ideally, investors should understand what they're investing in. And arguably I don't want to sound elitist, but your typical 401k plan investor out there, they may have a sort of an understanding of stocks and bonds and correlation, but as soon as we bring up the term alternative investments, that in itself is a huge category. So questions about whether people understand what they're getting into, questions about liquidity in market downturns. It's an unfortunate fact. Even though 401k plan is meant to be people's long-term savings, when markets do tank, there is a group of people that inevitably trades away at the bottom. And if you add on top of that the idea of being locked into a sort of a private equity fund with big potential surrender issues, that could be very problematic. So there are I think definitely concerns about this idea. I would encourage folks to kind of go into the DOL's website where they have all of these comments categorized and just go in and click through some of them and read them. I mean, there's a lot of very coherent arguments for and against, the inclusion of assets. But I think, I didn't do an exhaustive study, but I think the majority of the comments are negative, and that kind of makes sense, right? People, if you agree with something, your incentive to, write a letter in and agree with it is a lot lower than if you have a strong opinion in the negative, you tend to take action. So, but yeah, it's things like the fees, the complexity, and frankly, a lot of people for example, Christine Benz at Morningstar, she's kind of come out pretty strongly against this. And her argument is more like, let's set aside, whether alts are useful or not. Like, and we should be focused on the basics that we know work, which is getting people enrolled, getting people to, stay enrolled, educating people about not trading off at a downturn, educating people about the dangers of holding too much cash, getting employers to increase their match. I mean, these are all relatively low-hanging fruit that we could really make a big difference. Is bringing alternatives into the 401k plan system right now super necessary? I thought that was a very coherent sort of counter argument.
For sure. And I think automatic enrollment, we've seen huge gains there. And I think Christine Benz from your reporting said it's a solution looking for a problem, right? Like
Basically.
there's ways to do this other than taking these big investments from some of those alts providers and sticking them into your average American's 401k plan.
Yeah.
You didn't ask for my opinion, but I will say I do think that there's some issues, but given the long time horizons, I do feel like it could be helpful. And I don't generally side with all the industry lobbyists a lot of time, but I think on this one, there's a point to be had. Is that why they're doing it? I don't know. That's a whole nother thing. Why the actual and the fees that they're going to come with it is a whole nother argument. But I do think that there could be some value that outweighs some of the risks, especially if the average American isn't going in there tinkering around with these things that they don't understand. Which brings us to another good point that a lot of supporters often say the participants, right, aren't going to be buying the actual PE or private credit funds directly. Instead, they're going to be professionally kind of managed inside these target date funds that are going to be, weighted appropriately, et cetera. So how does that sit with some of the critics, and how do you think just materially that kind of reduces those concerns?
Yeah, I think it's a very important point. I'm sure our listeners will know, about the role that target date funds have now begun to or have been playing in the 401k plan industry. They're pre-diversified investment options that folks can just sort of opt into. Many plans, not all, but most, especially big plans with lots of participants and lots of assets, they're in the business of shunting people straight into a target date fund automatically. It's not even an election that you choose. As you join these plans, you have to elect not to be put into this default investment. And so there's a great argument to be made, I think, that there is a role for private assets and other things, alternatives to be within those target date funds that are managed professionally, that, they are going to be able to understand the liquidity problems and have, a liquidity sleeve potentially that they can use if there are redemptions and
Yeah.
sort of protecting some of these investors from their own worst instincts. I think that's a pretty solid case to be made, to be honest. I guess it could raise the cost on some target date funds, and some of these funds are already fairly pricey. So that would be a concern. But if the fees are right, I think it makes a lot of sense.
We agreed on that.
Yeah,
That was
there we
great.
go.
I'm loving it. We're off to a good start on this show.
Yeah.
Our next question was kind of stepping back. We did talk a lot about the alternatives entering into the 401ks and what that can mean for Americans and clients and et cetera. But in your reporting too, you mentioned safe harbor, and even I said, "Oh, maybe we should explain that to our readers that might not know." So, is that even like a bigger story? What is this kind of safe harbor proposal that's in there, and what's the importance of that?
Yeah, honestly, it's kind of like this sleeper issue that's really almost the private equity sort of topic is a spotlight that's actually hiding what's really, going on here. And this rule is, if you read it, is much broader than private assets. It actually is asset agnostic. So what it effectively does is give plan sponsors, the fiduciaries who are selecting investments within 401k plans, it gives them a quote unquote safe harbor, which in layman's terms just means straight up insulation from litigation as long as they follow a quote unquote prudent process in the investment selection. So the rule goes through 5 or 6 different points. But effectively, if a plan sponsor goes through an investment analysis and looks at the fees, the current valuation, the complexity, sort of liquidity, and there's 1 or 2 other bullet points, if they go through and they look at those points and they have a reasoned discussion and they decide as a group that, yes, we've considered all these factors and we feel comfortable with this investment, we are going to put it on the platform. That's it. If they go through that process, you cannot sue them over the performance of these funds, the fees that they charge. So it's a very powerful sort of legal technique or framework that exists under the Employee Retirement Income Security Act, which is the law that dictates all of this stuff. It sounds a bit technical, but in practice, it could actually have some really major effects, according to the reporting that I've done. And one of them would be insulating plan sponsors from cookie cutter lawsuits. So folks who are sort of involved in the 401k plan world, they'll know about this trend. Others, it might be news to them, but for decades now, large plan sponsors have just been hamstrung by just cookie cutter lawsuits, literally copy and pasted lawsuits that accuse them of imprudently investing in funds and underperformance or excess fees. And of course, there are egregious cases where fiduciary breaches have occurred, but Sean, literally, these plan sponsors are getting sued for having chosen a fund with a 25 basis point fee instead of 23. And it's really driven by the litigators who they target these massive plans.
Yeah.
They get these settlements and they left to the bank with 30, $40 million in settlements. And, the typical plan participant literally gets a check for 50 cents. So this is seen as a way to sort of prevent that. And personally, kind of taking my editorial hat off for a moment, I think that's a good thing because I spent in a prior publication the amount of time that we spent covering this litigation and just how sort of not pointless, but how just targeted it seemed. I think this is a good development, honestly. We'll see where it goes. It's a bit technical, but honestly, I think it could end up being a very good thing for plan sponsors.
You have a personal vendetta against these frivolous lawsuits from having to report on every single one for years and years.
Yeah. Well, honestly, at a certain point, we had an editorial discussion like, are we part of the problem here? Like we're giving attention to all these suits. And like at one point, so there was one famous law firm that I won't name that was really driving this. But then over time, two or three or four or five other law firms got into the game. And for a second, I was like, is our reporting like promoting this like cottage industry of excessive fee litigations? I don't know, but
I remember that
yeah,
from my days at Investment News, and Emil Halle, who's now here with us at the Daily Upside, but he
yep.
used to report on those very. I used to edit some of those stories, and yeah, he had the same kind of point of view as you. And I remember it was one big firm. I don't remember the name, so I can't even tell you who it was, but I do remember it was one firm, and he always used to, he would have the same kind of point of view as you, which.
And in the interest of fairness, the case that they make is that, yes, we may be suing this company over a 5 basis point difference in performance, but they really felt like they were on a bit of a crusade to sort of clean up the industry. And because they're, 95 out of 100 plan sponsors could be doing
Right.
things right, but if there are fiduciary breaches out there, it's important to recognize that. And to their credit, fees have come down across the board. Plan sponsors have been very diligent in general about their decision making. And so I think this is almost kind of like the best of both worlds, where a lot of the bad behavior has already been cleaned up. A lot of plan sponsors understand their responsibilities. And now they have potentially, if this becomes final, a very clear legal framework for protecting themselves. So it could, in the end, this really could come out as a win-win, I think.
I think to your other point about 25 bips versus 23 or 21, that can be significant when you talk about how many participants are in there and just the amount, hundreds of billions of dollars in assets that are in there.
Yeah. A lot of concerns about self-dealing amongst the record keepers and asset managers that need to be considered as well. So
It seems like the lawyers were taking that to the bank as well. So a related question to that then. The proposal seems to say fiduciaries should be judged primarily on their process rather than the investment outcomes and what happens afterwards. Is that a fair characterization of the proposed rule?
yeah, and it's really, really driving at the heart of what this is all about. The main thing to say is that nobody has a crystal ball, right, Sean? I mean, we can go into an investment opportunity, it can check all the boxes, there can be a black swan event, and you've lost money. I mean, that's a reality in investing. It's a reality for personal investing, and it's a reality for retirement plan sponsors who are selecting funds. Nobody bats 100%. Nobody can see where the markets are going and what sort of unacknowledged risks might be out there for a fund that otherwise looks on its face to be a perfectly prudent decision. So that's where this proposal really has a lot of power, I think, as I was kind of alluding to earlier. It really sets out a very clear legal framework for what is to be considered a prudent process under the law. And that's something that plan sponsors have really been hungry for. I mean, so if they go through the process, they look at an investment, they consider its fees, its current valuation, its liquidity, a number of other bullet points that are enumerated in the proposal. If they have a discussion amongst the group, they talk about the pros and cons of all of this. They document those discussions, what they thought about it, and they make a confident decision that this is a fund that we feel good about including and offering to our plan participants. We're putting it on there, and they sign off on that decision, and they all agree it was a prudent process, then that will give you a very strong degree of legal protections in the case that something goes wrong in the future. And personally, I think that makes a lot of sense, right? I mean, Sean, who would want to participate on a retirement plan investment committee if you weren't given that guarantee? Because I don't know if you're aware of this, Sean, but actually, as a retirement plan fiduciary, the way the law is written, you can personally be held liable for these decisions. It's not something, yes, the company can be held liable as well, but you as an individual can be sued over some of these questions. So I think it makes a lot of sense to offer plan sponsors a very clear definition of what a prudent process is, honestly. So that's really where this is driving. We'll see what happens in the final version. This could change, and it actually just occurred to me that I wonder, whether the final version of the rule could be significantly curtailed. I mean, it's just occurring to me now that this all started from a suggestion from the president that we try to get alternative investments into 401k plans. What this has actually come to be is a fundamental reassessment of the investment selection process within retirement plans. I think it's a good reassessment, but I could see a world in which, there's people challenge that premise. Oftentimes these rules can be challenged in court. That's something that we could see coming down the pike. So long story short, it's all about process, and this story is not over.
Thanks, John. That was awesome. I learned a lot, actually. I know our audience did as well. So let's move on to our next segment. This episode is brought to you by Fidelity. Growth, it's fundamental. And wealth management firms of all types are proven to grow faster with Fidelity. Because we'll work closely with you to help make your vision come to life. Deep expertise, powerful technology, and unmatched scale, we have everything you need all in one place to help your firm grow. Move forward faster with Fidelity. For more information, visit i.fidelity.com/growth. All right, so moving on to our second topic of the episode. John, you recently interviewed the well-known idol of our industry, Bob Dahl, at Crossmark. He's obviously been very, very popular in our industry for a long time, does his 10 predictions that I know readers love to hear. And a lot of times he actually comes back halfway through the year and does an update on them. So we all love to hear what he says. What did you guys talk about this time?
So, of course, we talked about the markets in general to start with. Bob, he gave me a great quote, which was that if you had asked him at the beginning of the year, if it were possible for there to be a large scale war in the Middle East, for inflation to be running hot, and for the markets to still be having a rip roaring time, he would have said that's impossible. But the key that he's seen that's really propped things up and has continued to lead to strong record equity market returns is corporate earnings. If anybody who's been following earnings seasons and sort of listening to the news about earnings this year, it's been a remarkable story of durability. And Bob hopes and expects that to continue. We never know. The day of we're recording here, another very solid jobs report, 172,000 jobs created last month. That's a very encouraging sign for the consumer economy and for corporate earnings here in the States. So the way he characterized the current moment is a high risk bull market, which is kind of an interesting thing, right? Things are going very well. If earnings hold up, that he has full expectations that, we'll continue to see very strong, potentially record equity market performance through the second half of the year. That being said, if there begins to be a sign of weakness in earnings, that could really, turn things around. So that's what he means when it's a high risk bull market. It's a market where a lot of upside is there, but there's also a lot of risk. So I don't know if anything jumps out at you, Sean, but it's a pretty precarious but interesting moment in the markets.
For sure. Yeah, I don't know where all that durability is coming from. I mean, oil prices are also hitting historic levels, so we'll see what happens. I kind of have a feeling, for no other reason besides it's a feeling, that it will probably, I think there's still room for this bull to run, but I do think we're going to probably come back down to reality in some areas. I think the AI investments are probably buoying this kind of run that we've had for the last couple of years, I guess since 2022, right? Are the returns on investments there? There's a lot of questions, and all the just consolidation of those few stocks that are really the ones that are driving all that performance, where the rest, the 80% of the S&P 500 is actually not doing that great. So how long it can last, I don't know. I'm waiting for a little bit of a pullback, and I'm going to invest a little bit more.
Yep.
Get out of cash a little bit, but I'm going to hang out a little bit for a bit here. I know that you also spoke to Bob about another interesting topic. I mean, obviously he's great talking about the economy and the markets, but he's very much now in the faith-based and value-based world of investing. And he said that Gen Z and millennials are ones that are really pushing this, where they're trying to invest for performance, but also on their values. What are the highlights about what he said about those conversations?
Yeah, I found that to be interesting. It was kind of cool having the dual-sided conversation, number one, just about the markets. But the main reason why we had connected was they recently conducted a survey of, I'm not sure how many thousands of Americans, but a broad-based, I think a pretty well-done survey, where they asked folks about, their understanding of and willingness to engage in faith-based and values-based investing. And what they found is that 44% of millennials and Gen Z said values-based investing is important to them. And what's eye-opening is that's more than double the rate of retired respondents, who at this point are baby boomers and the silent generation, I guess. So that's pretty telling. Another thing they found is that 3 in 4 respondents under the age of 41 say they would choose an advisor that offers value-based investing over one that doesn't. And I think that's pretty eye-opening. What really caught my attention, though, Sean, was that, having talked to Bob about that and knowing that he, represents Crossmark, and of course they do faith-based investing. And, if this is a survey about, the acceptance of faith-based investing, you have to put your reporter hat on and look for alternative sources of information. So what I did was went to the FPA, the Financial Planning Association. They have a really helpful tool that lets journalists like ourselves query their members. And I put in a basic query and said, I just spoke to Bob Dole. Here's what he told me about faith-based investing. folks are willing to leave their advisor for this. Have any of you guys seen this in practice? And Sean, I got an outsized response. Normally I do an inquiry like that. You might get 5 or 6 responses. I think I got just north of 15 or 16 responses on this from advisors out there. And by and large, they said, absolutely. Our younger clients, whether it's faith-based investing or more values-based investing, they're both very relevant. What I heard is that and I think this makes sense. I mean, think about our, millennials and Gen Z. They're folks who are, just saturated with information about what's happening in the world. The wars in the Middle East, domestic problems here at home, social justice issues, whatever you think about them, people are just inundated with information about what's going on in the world. And it's very, and Bob Dole agreed with this while we were talking. It's just much harder, I think, for them to sort of just separate the concept of saving and investing for the long term from what's happening, more broadly in the world. They don't see a distinction there. And I think there's a lot of merit to that. I think about a lot of my friends and folks in my generation. I'm an elder millennial, and I think that's spot on. I mean, people, they don't necessarily want to just think about investing and returns on one hand and sort of living their own social and personal lives on the other. I think there's more of a unity there.
Well, I think it's one way that they feel that they can empower themselves and their generation to actually make a change when it sometimes feels like the powers that be are already there and
Yep.
there's not a lot of ways to impact that. But I'd also say that I always hate the argument that like it's either performance or your values or ESG or faith-based because there's no real, I mean, there's data on everything. You find data points to back up any statement you want to make or any argument that
Yep.
you want to have. It doesn't seem like they're mutually exclusive. Like you have to give up performance to have ESG in a portfolio. And frankly, I don't see why you would. There's so many products out there and a lot of research that point to otherwise. So I don't really get that it's either or. Another thing that struck me, and maybe we'll get out of here on this question though, is that you said that clients are willing to leave their advisor over a lack of these face. That kind of thought to me, as you were saying with the reporter hat on, like, is that really, really happening? Are clients really saying, you don't have this or that fund and I really want it, so I'm going to just repaper and do all, I mean, these relationships are pretty sticky. So I feel like that I might push back at just a little bit to say, I'm wondering just how pervasive that is, or what would it take for a client to actually lead you if you didn't provide these services?
Agree. I think that stat, there's some truth to it for sure, but I think that's maybe an example where, survey respondents are kind of giving an opinion about, oh yeah, I think faith-based or value-based investing is
Right.
important. And I would theoretically leave my advisor.
Yeah.
When push comes to shove, in reality, it happens a lot less frequently. I did want to give a special shout out to an advisor who wrote back to me, Matthew Higbee, I think it is, at Birchwood Capital, because he didn't just write with an opinion. He actually crunched some numbers for me that was really fascinating. So he did a review of biblically responsible investing funds. There's like 10 of them out there that are pretty well known and have a decent amount of size. And he found that their performance, some of them were actually par with their benchmarks, like the broad equity industry benchmarks. One of them is actually superior performance, which was really interesting, but most have lagged by between 100 and 400 basis points. So it is important to distinguish between things like values-based investing, where you're maybe making a call about the importance of sustainability on a long-term portfolio. That's one thing. Applying biblical principles to a portfolio is something different. So it's important for people to understand that, this is a broad category. And to Matthew's point, some of his clients, they're devout Christians. They're perfectly willing to give up 100 basis points if it means that their portfolio actually aligns with their beliefs. So just quite interesting. We could go on and on, but I thought I wanted to thank Matthew for his the math that he did. It was quite interesting.
Kudos to him for sharing that information, even though he is very much in the faith-based. I think the faith-based is probably, like you alluded to, a little bit more, I don't want to say extreme, but they will be giving up performance or willing to give up performance. 400 basis points seems like a lot when, I mean, I know the markets are getting 15% annually or whatever it is, but if that compresses and if they're only 5-6 percentage points up, giving up 400 basis points or 4 percentage points seems like a lot. We'll see how that plays out, but yeah, kudos to him for sure.
All right, Sean. Well, it's a busy time here at the Daily Upside, but it's awesome getting to carve out a little bit of time to do the podcast. I think it really complements our newsletters very well. If folks aren't subscribed, please go ahead over to the website. We have the Advisor Upside newsletter, the ETF Upside newsletter, the flagship Daily Upside, and we have the newsletter that's maybe nearest and dearest to my heart, the Retirement Upside. please, consider subscribing to those. If you do, you'll get a very holistic, up to date, news driven source of information that will really help you, we hope, in your practice. So, Sean, why don't you close out the episode?
Hope you're enjoying the podcast as well. Give us a review wherever you can. Subscribe on YouTube. We're also on anywhere you get your podcast. So please give us a big thumbs up. We'll love you forever. And we'll see you next time. Thanks a lot.